Today, we're focusing on the sentiment we're seeing among manufacturers. We're drilling down into some of the subcategories that really kind of tell us how manufacturers are feeling, not just about the overall financial picture, their overall business conditions, but specifically the different types of levers that they can pull, whether it's hiring, whether it's the amount of inflation they're experiencing, whether it's the amount of investing they're looking to make. And what this chart does is it averages responses across 5 different regions in the country through surveys that are done by the Federal Reserve. We're going to focus on 2 aspects of business sentiment, specifically manufacturing business sentiment. Number 1, how much are these companies paying for raw materials or inputs? And number 2, how much, if at all, are they changing their plans to make capital expenditures? Things like buying new equipment, installing new software, building new structures, things that tend to take a long time for businesses to do, have some risk associated with them because you're using cash on hand to make an investment that might not pay off until sometime in the future. You can see from the graph that these things normally move together, and that makes sense. When prices are rising, firms are looking for ways to improve efficiency. The economy is probably good enough that they feel confident about deploying that capital. So at times when you're seeing very, very pronounced inflation, you tend to see very, very strong CapEx. At times when there's disinflation or deflation during recessions, there tends to be very, very weak CapEx. Today, they aren't moving together. And that's really the interesting part about this chart as we look at the story of 2025. Why aren't prices and CapEx plans moving together today? Well, remember Liberation Day, I talked about at the outset. Firms began almost immediately following that to report the fact that they face higher input costs. Think of a car manufacturer that is paying or expecting to pay higher prices for steel or for some of the parts that they use to make the cars in the United States. And as soon as tariffs started to be layered into place, we were seeing this prices paid number start to move up. But the uncertainty associated with the tariffs and the overall economic outlook and how severely the tariffs might dent profitability also led to a pullback in overall expenses. Things like hiring, we're seeing job market slow down a bit, but also CapEx. And so that CapEx line has moved down at the same time as the prices paid line has moved up. This is one of the reasons we're starting to see whiffs of mentions of stagflation in the markets. We call it stagflation light because growth isn't actually shrinking, it's not contracting. But we are seeing growth slow down at the same time as inflation is picking up. One of the stated purposes of the tariffs is to stir more domestic investment, but we're not seeing that happen, at least not really outside of the AI area that probably isn't being captured by this graph since we're looking mainly at manufacturers. The prospect of higher input costs may actually make it more likely that firms maintain a presence outside the US. So you have 2 choices. One is you can have your input costs move up because you're importing things from overseas to make whatever product you're planning on selling, or you can locate overseas, have all the input costs be lower, but then face the prospect that your goods are going to be taxed when they come into the United States. And not every firm is going to decide the same way how to respond to that set of incentives. The only other time we've seen a divergence like this was in 2007, 2008, which is obviously a very scary time period to mention, but don't be too frightened. That was a very different set of circumstances. We were seeing commodity prices specifically spiking. We're not seeing that today. Oil prices, copper prices were rising really fast. There was some speculation that China was hoarding these things, and there was this sort of a scarcity concern. That's not really what we're seeing today. And we're also not seeing as pronounced weakness in the economy as we were at the end of 2007. Eventually, in that period, the way these things resolved was the prices moved down. They fell in sympathy with the CapEx decrease as well. The hope for 2026 is that the CapEx plans, the lower line, are going to move up and turn up as the rules of the road on trade become clearer and firms that are facing higher input costs are more willing to deploy capital to try to enhance productivity to sort of mitigate the impact on their profitability. We actually got some hopeful news from the Philadelphia Fed survey for August. So the Philadelphia Fed is the first regional Fed to come out with their monthly survey. That showed improving plans for CapEx against expectations and also rising input costs, so no resolution there yet, and falling new orders. So not a completely positive report, but the plans for capital expenditures over the next 6 months is rising in that report, which is certainly a positive sign. Rising CapEx tends to mean better growth in the future, as these things tend to be productivity enhancing when they come online. And so many of the investments that we make as portfolio managers and as managers of our clients' money, whether it's private equity, whether it's infrastructure, whether it's public markets, are very much tied into that story. The productivity enhancing investments today are going to mean higher returns in the future. Thanks so much for watching. We'll get back with you very soon.